Now that we understand what market structure is, how we can identify a bull or bear trend, and how it applies to supply and demand, the next logical step that we must take is understanding the multi-time frame level of market structure and how we're able to dissect a bear trend or a bull trend on the higher time frame and understand how the components apply fractally down onto the lower time frames. So for example, if the daily chart is showing an uptrend, making higher highs and higher lows, if we're looking on a lower time frame, we would expect to be seeing higher highs and higher lows. But the one thing that we need to start to understand is the fractal nature of the markets, in that we will see higher highs and higher lows on the lower time frame, but we're also going to see a series of lower lows and lower highs as it facilitates the pullbacks on the higher time frame. And here we have a standard textbook infographic of an uptrend and a downtrend. As we can see with the uptrend, price is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. We then break to the downside, creating a lower low. We create a lower high. We create a lower low. We create a lower high and a lower low. And if we take that a step further and say that the blue line is our higher time frame structure, so say a daily time frame, and the red structure is our lower time frame structure, so let's say 4 hour or maybe even 15, what we would see as price is moving to the upside, we'd see a series of higher highs and higher lows. We create that highest high on the daily time frame, our higher time frame. And then when the higher time frame is starting to pull back or retrace to put in its higher low, what we would be seeing more than likely on a lower time frame is a break of structure, creating a lower low, a lower high, and then a lower low. This lower low that forms on the lower time frames is in essence the higher low that's formed on the higher time frame. And then what we'll see is as price begins to move to the upside as this higher low has been formed, we'll see on the lower time frame that price breaks structure, putting in a higher high. We'll put in a higher low, a higher high, a higher low, and then a higher high, which forms our higher high in this case. And as we can see, once we get to this point, we've broken the previous higher time frames higher high, and we're starting to see the continuation of the bull trend. And this will continue, and as we'll see, when price begins to retrace on the higher time frame, on the lower time frame, we'll start to see a series of lower lows and lower highs until we put in the higher low on the higher time frame. And then at that point, we'll see a break in structure, and we'll start to see the lower time frame creating higher highs and higher lows, higher highs and higher lows. We'll see price then break that higher time frame structure and start to put in a higher high. And again, on that lower time frame, we're still seeing a series of higher highs and higher lows. We'll put in that highest high, and then we'll see price switch trend again. And what we'll often see as well is price may not actually break structure on the lower time frame as well. In this example, what we can see is price basically creates a double bottom, but price is within this range of price on, say, the 4 hour or 15-minute time frame, and we haven't actually broken structure. We haven't actually created any lower lows. We're still in a bull trend. This can also happen as well, so don't always expect that lower time frame has to create lower lows and lower highs as it's retracing in a bull trend. But then we'll see price starts to build higher highs and higher lows once more. We break the higher time frame higher high, putting in a new higher high on the higher time frame, and then the cycle continues where we start to see a lower low printing, a lower high. And at this point, what we can see is our higher time frame swing structure would be here. And as we break to the downside, what we can now see is we're seeing a change of character, meaning that we were expecting a higher low to form and price would continue moving to the upside. But what has actually happened is price has broken the previous higher low and is now forming a lower low. And as we can see on the lower time frame structure as well, we're creating lower highs and lower lows. And as the higher time frame puts in a lower low, we can see that price is logically going to start to retrace or correct. And on the lower time frame, we can start to see that price is creating a series of higher highs and higher lows. And what we can see in this case, we would break this structure. This would be the higher high on the lower time frame, which would form our lower high on the higher time frame. And then what we can see is price then starts to move back to the downside. We create a lower low, create a lower high, a lower low, a lower high, a lower low that breaks this previous low, confirming our bear trend, creating that lower low. And then on the lower time frame, we're still creating lower highs, lower low, which is also our lower low on the higher time frame. And then what we see is price is now starting to make a series of higher highs and higher lows, higher highs, higher lows, higher highs. That creates now our lower high on our bear trend, Price then breaks to the downside, creating a lower low on the lower time frame, and then starts again the cycle of making lower lows and lower highs as it continues down on the bear trend. And this is what is happening conceptually on all time frames, because what essentially time frames are on a price chart are just a series of data that you can graphically depict using different time frames. The time frames itself are just data, different ways of viewing that data, which is why you can pick different time frames, and why if you're using TradingView, for instance, that you can start to look at custom time frames like 45 minute, 30 minutes. You can use 8-hour time frames, 3 hours, 2 hours. At the end of the day, the time frames in which you use are ultimately up to you in terms of what data you're hoping to gain from the chart. But one thing that I do strongly suggest when it does come to market structure, mapping market structure, and following a logical flow in market structure, it's best to pick a few time frames and follow them more specifically, because what will end up happening is if for a while you're using, say, the daily, the 4 hour, the 1 hour, the 15 minute, the 5 minute, then the 4, 3, 2, 1 minute, you're going to start just looking through time frames to essentially match whatever it is you're trying to find on the chart. Whereas if you have your main time frame, so me personally, I like to use the daily, the 4 hour, the 15 minute, and the 1 minute. Those are the time frames that I focus on, and those are the time frames that I watch. So anything else that's on there, I don't really concern myself with too much. I will also look at the weekly and the monthly for higher time frame understandings of what is going on, but the main time frames that I'm concerning myself with on a daily basis are the daily, the 4 hour, the 15 minute, and the 1 minute. And if I'm always locked in on those time frames and I'm constantly monitoring what's happening on the daily in terms of the higher time frame market structure, then looking at the 4 hour for the market structure, and then the 15 minute, I can build a solid understanding of what is happening on all time frames. If I know that the daily's in an uptrend, we've just put in a higher high and price is starting to pull back. I know realistically on the 4 hour and the 15 minute, what we would likely see is a downtrend, especially given if the range in price on, say, the higher time frame is large. That means the pullback in theory could be large. And if I combine that with supply and demand zones, map out where, in this case in an uptrend, where all the demand zones are that would in theory cause price to continue higher, I can then map out where logically higher lows would form. And if I'm using lower time frames and I know that price is making a series of lower lows and lower highs approaching my demand zone that I'm looking to enter on, then I can make higher probability and more informed trading decisions by using and understanding market structure. We're going to tie in market structure with how we go about looking for entries. We're going to piece all of this stuff together, but the main thing is understanding supply and demand, how it integrates with market structure, and then now understanding how all of the different timeframes can build that overall picture of market structure and how all of the trends that we're seeing are being built on all time frames. It's all happening fractally, meaning that it'll happen on one time frame, it'll happen on another time frame. Generally speaking, trends will start on the lower time frame, say the 1 minute, and build their way up. But at the end of the day, the direction that's easier to find, follow, and navigate is the higher time frame trend, because effectively what is needing to happen is if you see a trend change on the daily chart, for instance, it's going to take a few days to actually build what you would understand to be a trend change. Whereas if you're looking at a 1 minute trend, you can see price creating higher highs and higher lows for a few minutes, and then creating a series of lower lows and lower highs for a few minutes, and then creating more higher highs and higher lows, creating that uptrend. But then if we were to zoom out, maybe go to a 15 minute, then what we can see is that movement on the 1 minute was actually just an uptrend on a 15 minute, and fractally that's what was happening. We were seeing that uptrend, we were seeing that correction that was on the 15 minute chart, but it looked like a downtrend on the 1 minute chart, and then we started to see that uptrend again because the 15 minute began to make a new higher high, and vice versa with a bear trend. So this is something that's incredibly important to understand. It's something that fundamentally many traders understand, but they don't put as much emphasis in truly mastering and understanding how one time frame translates to another. So really take the time to understand this approach, understand market structure, understand its importance, and how we can create high probability trade ideas by understanding the narrative that's being built on the higher time frame and how it works its way down to even as low as the 1 minute or 30-second, 5-second time frames. They're all building these sorts of trends, and if we can put all of the data together in a logical manner, we can make incredibly informed trading decisions based on the order flow. We start to throw in supply and demand concepts, and that opens up a world of possibilities on what the markets are ultimately going to be doing.